Welcome to the Ultimate Beginner's Guide to Order Flow Trading. In this course, you will gain superior knowledge about the tools of order flow analysis in record time. Technical analysis focuses on analyzing historical data to predict future price movements based on known patterns. In contrast, order flow delves deeper into the dynamics of how prices are formed by shining light on market microstructure, meaning how buy and sell orders are placed, matched, and executed in the market. Order flow analysis possesses tools for assessing price formation in real time, as well as tools to analyze how price was formed in the past. In short, order flow has the capacity to unveil information that cannot be seen with price action reading by itself. So order flow is a great ally for price action reading, as you'll see throughout the course. This course is constructed in a top-down manner. First, we're going to quickly study the auction market theory, which provides the necessary theoretical framework to understand market microstructure and order flow trading. Market microstructure is what allows us to understand the intricacies, pitfalls, and opportunities that exist in the way buy and sell orders are placed, matched, and executed in the market. Next, we're going to delve into the various actionable order flow tools and strategies that are worth paying attention to as a retail trader. You'll learn what tools to avoid and what tools to focus on. Without further ado, let's begin by talking about auction market theory. The auction market theory was developed by Peter Steidlmayer, who was a trader at the Chicago Board of Trade in the 1980s. Steidlmayer also created the market profile method, which I'm going to talk about in future courses, and is similar to the volume profile tool. The auction market theory is based on the idea that the financial market serves as a place to facilitate trading between buyers and sellers in a way that is like the bidding and offering process of an auction. To keep things simple, buyers always want to buy at the lowest price, and sellers always want to sell at the highest price. The point where these two opposing forces meet is what is known as point of equilibrium. It's also referred to as efficiency, balance, or fair value. Notice that auction market theory is based on the fundamental principle of supply and demand in economics. Price is the point where supply and demand curves intersect, meaning the point where buyers and sellers agree. The search for efficiency, equilibrium, balance, or fair value of a market is not static. Buyers and sellers are always changing their perception about the market due to many factors. Such factors include major macroeconomic forces, news events, overall market sentiment, and technical factors, to name a few. When a new piece of information emerges, that changes the perception of buyers and sellers related to the fair value of a market. In other words, it creates an imbalance. An imbalanced market starts the process of price discovery, meaning the discovery for the new fair value. When markets are balanced, they trade in a range. There is no motive for price discovery, since buyers and sellers are relatively comfortable with the perception of value of the market. When markets become imbalanced, we have trends. One fundamental idea here is that markets respond to previous areas of balance and imbalance. Balanced markets, which are sideways, are recognized as areas of acceptance. Imbalanced markets, which are trending, are recognized as areas of rejection. Price tends to be attracted to areas of acceptance and repelled from areas of rejection. All of this, of course, assumes that no new information has affected the perception of buyers and sellers. In auction market theory, we have three main components: price, time, and volume. Price acts like an auctioneer that balances the forces of supply and demand in the market at all times. Time serves as an indicator of acceptance or rejection, like it can be seen in the market profile methodology. The amount of time price spends in a price level shows whether price accepts or rejects that level. Volume helps confirm acceptance or rejection. Areas of acceptance are marked by higher volume, and areas of rejection are marked by lower volume. In auction market theory, we also have the concept of value area, which simply represents the price range where 70% of the traded volume occurred within a specific time period. The price level where the highest volume occurred is called point of control. This value of 70% is based on the empirical rule in statistics, meaning that in a Gaussian distribution, we have 68% of the data falling within one standard deviation away from the mean. Traders round that up to 70%. We'll talk more about this when we look at the volume profile. Keeping these basic principles in mind, it's time now to move on to the subject of market microstructure so that we understand the nuts and bolts of how price action is formed in the charts. This might seem confusing and unnecessary at first, but it's extremely important to understand, otherwise you'll be completely lost later. Let's begin first by talking about the different kinds of orders that exist in trading. To keep things simple, we can summarize order types in two categories. We have market orders and we have pending orders. A market order is an order to buy or sell immediately. For example, if you want to buy at whatever price is being traded right now, you will use a market order. The same is true, of course, for a sell order. A pending order is an order to buy or sell at a price different than what is being traded right now. In that sense, we have two main types of pending orders, the limit and the stop order. The limit order is a pending order to buy or sell at a better price than what is being traded right now. For example, a buy limit order is always below the current price since buyers always want to buy low. A sell limit order is always above the current price since sellers always want to sell high. The stop order is a pending order that becomes a market order once price reaches a predetermined level. Notice that stop orders allow traders to trade in a worse price. Buy stop orders are always above the current price, and sell stop orders are always below the current price. One key difference between stop and limit orders is that limit orders are active, meaning that they are directly placed in the market, while stop orders are inactive, meaning that they are held by the broker. If the market reaches the level where the stop order was placed, the broker immediately transforms it into a market order. That means that only the broker can see your stop orders, but limit orders are visible to the entire market. So to make this absolutely clear, let's analyze the types of orders involved in a simple trade with stop loss and take profit orders. Let's begin with the long trade. Imagine that you opened the long trade using a market order. If the trade was opened with a buy order, in order to close the trade, you need to execute a sell order of the same size, so both the stop loss and take profit target orders of a long trade are sell orders. The stop loss of a long trade is a sell order that is below the price you open the trade, so it's a sell stop order in a worse price. The take profit of a long trade is a sell order that is above the price you open the trade, so it's a sell limit order in a better price. Imagine now that you open the short trade using a market order. If the trade was opened with a sell order, to close the trade, you need to execute a buy order of the same size, so both the stop loss and take profit target orders of a short trade are buy orders. The stop loss of a short trade is a buy order that is above the price you open the trade, so it's a buy stop order in a worse price. The take profit of a short trade is a buy order that is below the price you open the trade, so it's a buy limit order in a better price. One easy way of remembering all of this is that market orders get you filled at the current price, limit orders get you filled at a better price, and stop orders get you filled at a worse price, keeping in mind that buyers want to buy low and sellers want to sell high. Notice also that stop orders can be used either to get out of a trade or to initiate a breakout trade, for example. Recall also that limit orders are active, meaning that they are placed directly in the market, while stop orders are inactive, meaning that they are held by the broker until the market reaches the level where they are triggered. This is one of the reasons you need to choose a reliable broker. Notice that not all buy orders have the intention of adding buying pressure, and not all sell orders have the intention of adding selling pressure. In the case of pending orders, the intention can be to stop or limit price movement. This leads us to different types of market players. There are basically two types, the aggressive and the passive players. Aggressive players are the ones that initiate price movements, and they do so through the use of market orders. Passive players don't initiate price movements, but they can slow it down or stop it, and they do that through limit orders. That also means that passive players demonstrate intent across different price levels, as we'll see later. Another way of thinking about aggressive and passive players is that aggressive players take liquidity from passive players, and passive players provide liquidity to the aggressive players. It's important that you acknowledge a few basic rules about the interaction of market players. A buy order must always match a sell order. In other words, if you want to buy, there must be someone else on the other side willing to sell, and vice versa. An aggressive order must always match a passive order. With all these concepts in mind, let's move on to hypothetical scenarios in one of the order flow tools called the order book. The order book shows the buy limit orders below the current price in the bid column on the left, and the sell limit orders above the current price in the ask column on the right. The order book shows the dynamics of limit orders in real time. Notice that the order book is very similar to another real-time order flow tool called Depth of Market, or DOM. The difference is that the DOM is easier to read since the size of bars in the bid and ask columns are proportional to the number of limit orders, giving an instant perception of market depth to the trader. However, they basically show the same information. This is a good moment to explain the concepts of liquidity and market depth. Liquidity is the ease with which a market can be traded without causing significant changes in price. Market depth is the number of orders in a given price level. A deeper market means that more trading activity can occur without causing significant changes in price. By the same token, a shallow market means that significant changes in price can occur with low levels of trading activity. Let's take a hypothetical scenario where buyers, for whatever reason, feel that the current price is low, and they decide to buy. Recall that market players that initiate price movements are aggressive players, and they do so with market orders. Recall also that an aggressive order must always match a passive order. For price to rise from 50 to 51, aggressive buyers must take the liquidity provided by the passive sellers in the 50 price level first. In this example, there are 23 sell limit orders in that level. To go from the 51 to the 52 price level, the same process needs to occur, of course. Notice that in this case, the ask column has shallow market depth, so the aggressive buyers can cause a more significant rise in price with not a lot of aggressive power. In the higher prices, market depth begins to rise, and the aggressive buyers require more power to produce the same change in price. The same mechanics, of course, happen in the bid column. That is how prices effectively rise and fall. Like I said previously, the order book, or the DOM, is a real-time tool to assess the intention of passive players, and here begins the problem. Since this is a real-time tool, it is subjected to different kinds of manipulation maneuvers. For example, buyers can place significant buy limit orders in a specific price level with the intention of attracting the market to that area, but with no intention of getting filled. They can cancel the orders just before they are hit. This problem became significant especially after the rise of high-frequency trading algorithms in 2008, which can basically automate this process. So the market depth reflected in the order book, or DOM, doesn't necessarily correspond to the real intention of buyers and sellers. Let's briefly go over different kinds of manipulation maneuvers that can occur in the order book, or DOM. Spoofing. This maneuver involves the placement of large limit orders with no intent of having them filled. In other words, passive players can place large orders that will appear in the order book, or DOM, to create the illusion that there is a lot of intent in a particular price level, but in reality, these players don't have the intention of executing these orders. They just want to induce the illusion of liquidity or supply and demand on other market players. Such orders can be quickly cancelled just before price hits them, for example. The problem, of course, is that there is no way to tell if the large orders exist for a legitimate intent or if they are a result from spoofing. Iceberg orders. Institutional traders have access to trading platforms that allow them to place what are called iceberg orders, which are limit orders that appear partially in the order book, or DOM. When the visible portion of the order is executed, another portion of the order emerges and gets executed. The reason behind this is to hide the intent of having a very large order appear in the order book. A retail trader has no way to tell if the order book, or DOM, is hiding an iceberg order. So a price that appears to have shallow depth might be hiding an iceberg order, which would obviously be misleading. There are other types of manipulation maneuvers like painting a tape and layering, but the understanding of spoofing and iceberg orders is enough to understand the misleading nature of real-time order flow analysis. In conclusion, when observing the order book or the DOM, shallow price levels might actually be deep, and deep price levels might actually be shallow. There is of course no way of telling the intention of passive players just by looking at these real-time tools. As retail traders, there is a very high probability of being misled by more astute institutional traders manipulating the order flow. All this talk about algorithms manipulating price is related to real-time order flow, not historical order flow. This information might seem inoffensive, but its importance will grow as we progress. So this deceptive mechanics of the real-time order flow is one problem, but it doesn't stop there. Another problem here is that traders tend to assume that buying and selling always have directional intent. That's not true. Certain kinds of market participants don't buy necessarily expecting that price will rise or sell expecting that price will fall. The key to understanding that is that there are mainly three types of market participants: speculators, arbitrageurs, and hedgers. Speculators are what most retail traders expect every market participant to be. Speculators want to capitalize on the directionality of price movements, meaning buying low and selling high. If the market was made only of speculators, the order book would be less misleading, although the manipulative tactics we just saw would still be a problem. We also have arbitrageurs. This kind of market participant is not worried about market direction. They want to capitalize on the difference between two markets, which often involves buying one market and selling another simultaneously. In other words, when arbitrageurs buy or sell a market, they don't necessarily expect this market to rise or fall. Statistical arbitrage is a good example. These kinds of traders don't trade market direction. They trade the statistical relationship between two or more markets. For example, if an arbitrageur buys market A and sells market B, he doesn't care if market A falls as long as market B falls more than A. That is a simplistic example, but it illustrates how buy and sell orders don't necessarily have directional intent behind them. If you want to learn more about arbitrage, I have an ebook about it called Statistical Arbitrage by Cointegration. Cointegration is an idea that won the Nobel Prize in Economics, and it lays the foundation for arbitrage strategies in the institutional trading world. It can also be used by retail traders. The third type of market player is the hedger. This kind of market participant aims to reduce or eliminate some kind of risk by using the financial markets. The classic example here is delta hedging used by banks, which involves buying call options at the same time that they sell the underlying financial instrument following a certain proportion. The aim is to eliminate delta or directional risk. That's useful to mitigate some of the credit risk associated with lending operations. In summary, just because they sold the market doesn't mean they want it to go down, because they are not trading market direction. They are trading market volatility. I have a video here in the channel demonstrating how delta hedging occurs. I'll leave it in the video description or card. The term delta here is completely unrelated to the delta we'll study later. The first relates to the delta or directional risk of the market given by the Black-Scholes formula, and the latter relates to volume delta, which is the difference between bid and ask volume. In conclusion, not every market participant buying or selling has directional intent like most retail traders expect. That is a problem because it obfuscates the order flow process. In real-time tools like the order book or DOM, the situation is even worse because there are different ways of manipulating the perception of intent through limit orders as we saw. If you're still not depressed, let me try again. Beyond the problem of manipulation in the order book and the problem of ambiguity due to the diverse nature of market participants, we also have the problem of hidden volume. Hidden volume occurs primarily due to OTC or over-the-counter trading and dark pools. OTC trading is when trades happen between certain parties without going through a centralized exchange. This is a problem, of course, because it can obfuscate the real level of market activity to the general public. This is not a small matter since OTC trading is usually done by large players such as pension funds, hedge funds, sovereign wealth funds, and very large companies. Just so you can have some perspective, The volume traded in the OTC markets is a few times larger than the global GDP. In 2023, it is estimated that the global GDP was around $100 trillion. The volume traded in the OTC derivatives market alone was 600 trillion, according to the Bank of International Settlements. Dark pools are private off-exchange trading venues where large institutional investors can execute trades without publicly revealing their orders until after the trade is completed. Dark pools are primarily used to minimize the market impact of large transactions. The lack of pre-trade transparency is clearly a problem if traders are looking to analyze the real-time order flow of a market. In summary, the manipulation in the order book with the tactics such as iceberg orders and spoofing, the ambiguity generated by different kinds of market participants such as speculators, arbitrageurs, and hedgers, and the lack of transparency due to OTC and dark pools, hidden volume, lead us to conclude that the real-time analysis of order flow done by retail traders is mostly a vain exercise. Given that trading is a game of asymmetric information and retail traders are always on the weaker side, we need ways to analyze order flow in a more concrete way. In other words, we cannot rely on tools that show real-time intent. We need to rely on tools that tell us what in fact happened with the order flow. One of these tools is what is called time and sales, also referred to as the tape. However, things happen too quickly in the tape, it's a difficult tool to use, and there are better options for analyzing the historical order flow. The conclusion here is that we should focus on tools that highlight important aspects of historical order flow. That solves the problem of dealing with manipulation tactics in the order book or DOM, such as layering, spoofing, and iceberg orders. Historical order flow tools will show us what in fact happened, not the misleading intention of various market players. However, by using historical order flow tools, we still have the problem of ambiguity and the problem of lack of transparency or hidden volume. The problem of ambiguity can be mitigated by changing our perspective. Instead of looking at order flow as a tool to identify directional movement, we look at it to identify levels of activity. The problem of lack of transparency still remains. One way of dealing with this problem is to focus on futures trading because futures are traded on centralized exchanges, unlike Forex, for example, which is decentralized. You can read order flow in currency futures to obtain more transparent information and trade on Forex charts, for example. In conclusion, use historical order flow tools, focus on identifying levels of activity instead of identifying directional intent, and focus on futures trading if you want to obtain more reliable order flow data. There are many historical order flow tools, but we'll focus on 3 of them for simplicity's sake: the footprint, the volume profile, and the cumulative volume delta. Let's begin with the footprint. The footprint shows the same information given by the time and sales or tape, but it displays it in a useful and relatively easy way to observe. Once again, the idea is not to identify directionality, but to quantify the activity of buyers and sellers in the price levels within a candlestick. Recall that when we looked at the order book, we were analyzing limit orders, limit buy orders in the bid and limit sell orders in the ask. Those were the real-time orders of the market. The footprint is a historical order flow tool, meaning that it shows the orders that got executed, not the orders that might be executed. In this sense, the bid and ask columns of the footprint demonstrate aggressiveness, meaning that the bid column shows selling aggression and the ask column shows buying aggression. That might seem confusing, but you must remember that an aggressive order always matches a passive order. In summary, the bid column shows passive buying intent in the order book, but in the footprint, it shows the aggressive selling that actually took place. The ask column shows passive selling intent in the order book, but in the footprint, it shows the aggressive buying that actually took place. When buyers attack sell limit orders, this activity is represented in the ask column. When sellers attack buy limit orders, that activity is represented in the bid column. Make sure you understand this perfectly. Before we move on to the features of the footprint chart and how to use it, let's make sure we clarify a problem related to the matching of orders. Let's go back to the simple example of a long trade with the stop loss and take profit target orders and analyze where each of these 3 orders will appear in the footprint. Imagine that you open a long trade with a buy market order. That is an aggressive buy order, so it matches a sell limit, and therefore it will appear on the ask column of the footprint. If your trade gets stopped out, a sell stop order will be triggered. A sell stop order is a sell market order that matches a buy limit order, and therefore it will appear on the bid column of the footprint. The take profit is a sell limit order that, if triggered, will match a buy market order, and it will appear on the ask column of the footprint. Imagine now that you open a short trade with a sell market order. That is an aggressive sell order, so it matches a buy limit, and therefore it will appear on the bid column of the footprint. If your trade gets stopped out, a buy stop order will be triggered. A buy stop order is a buy market order that matches a sell limit order, and therefore it will appear on the ask column of the footprint. The take profit is a buy limit order that, if triggered, will match a sell market order, and it will appear on the bid column of the footprint. It's key to remember that not all aggressive orders have intent of adding buying or selling pressure to the market. For example, the stop loss of a sell, which is a buy market order, can match a take profit from a buy, which is a sell limit order. This will appear on the ask. Both traders are leaving the market, and yet the footprint would reflect aggressive buying in the ask. The stop loss of a buy, which is a sell market order, can match a take profit from a sell, which is a buy limit order. This would appear in the bid. Both traders are leaving the market, and yet the footprint would reflect aggressive selling in the bid. With that in mind, let's begin understanding the features of the footprint chart. The footprint chart shows two columns, one in each side of the candlestick in question. You can change the level of resolution of the price levels according to your liking. The column on the left shows the bid volume across different price levels of the candlestick, recalling that on the footprint, the bid column shows selling aggression, not buying intention, like in the order book. The column on the right shows the ask volume across different price levels of the candlestick, recalling that on the footprint, the ask column shows buying aggression, not selling intention, like in the order book. It's a mistake to associate red cells with directional selling only and green cells with directional buying only, as we saw previously. The cells with lighter colors show price levels with lower volumes, and logically, the cells with darker colors show price levels with higher volumes. The cells in black demonstrate the price level with the highest level of activity. This is known as HVN, or high volume node. This can be useful when trying to judge which price level within a candlestick future price action can react to. If this was the price level with the highest volume, is the price where buyers and sellers found fair value for the most part, and it can be used later as support or resistance. Another feature of the footprint is called the value area. As a default, the value area is the range of prices where 70% of the volume occurred. This level of 70% is not arbitrary. If we recall the empirical rule in statistics, we see that 68% of the data occurs within one standard deviation from the mean in a Gaussian distribution. Traders simply round that number up to 70%. This is therefore the range of fair value within the candlestick. The high volume node is simply the peak of the distribution within the value area. The limits of the value area are displayed as VAH, which means value area high, and VAL, which means value area low. This is the same idea of the volume profile, but instead of measuring the volume distribution in a series of candlesticks, the footprint shows the volume distribution within the candlestick. Another important feature of the footprint is called imbalance, which is highlighted by green or red thin bars on the side of the price levels where the imbalance occurred. It's important to note that we don't compare price levels horizontally in the footprint. We compare them diagonally, like so. That's because when buyers attack passive sellers, they do that one price level above. When sellers attack passive buyers, they do that one price level below. As a standard, the imbalance occurs when there is a 300% discrepancy between price levels, meaning when one price level has at least 3 times more volume than the price level immediately above or below. When the discrepancy occurs in the bid, there is a bid imbalance. When the discrepancy occurs in the ask, there is an ask imbalance. The terms buy or sell imbalance are not really appropriate because not every selling aggression comes from sellers willing to add selling pressure not every buying aggression comes from buyers willing to add buying pressure, as we saw before. In this candlestick, we have 3 imbalances in the ask and 1 in the bid. Let's analyze the highest one in the ask. We see that in the imbalance level, there is a volume of 24,000 in the ask. One level below in the bid, we see that the volume was 6.9 thousand. If we measure the ratio here, we'll see that the ask volume was 3.46 times larger. That is why this is marked as an imbalance. If we look at the bid imbalance at the top, we'll see that the bid volume was around 17,000 in comparison to 2.6 thousand in the ask. That's 6.5 times larger. Imbalances can also be stacked. For example, when there is more than one imbalance in successive price levels, we have stacked imbalances. Another important feature of the footprint is the volume delta. The delta is nothing more than the difference between ask volume and bid volume. Generally speaking, bullish candles have positive delta and bearish candles have negative delta, but not always, as we'll see in a moment. The footprint basically serves 2 different purposes. We can use it to identify support and resistance levels in different ways, and we can use it to validate any other type of support and resistance we find in a candlestick chart. Let's begin with the ways of identifying support and resistance levels with the footprint itself. There are mainly 2 ways of using the footprint to identify support and resistance levels: consecutive high volume nodes and stacked imbalances. Let's see an example of both. Single high volume nodes are usually not strong enough to provide meaningful support and resistance levels. But when high volume nodes happen consecutively in the same price level, there is a higher chance that they will act as support or resistance. In this image, you can see an example of that. We can see 3 different price levels with multiple high volume nodes. The first has 2, the second has 3, and the third has 2. We see price returning to this high volume area later and then resuming the movement to the upside. In this other image, you can see an example of stacked imbalances working as support. The low of the large bearish candlestick is formed by 4 stacked imbalances in the ask column, denoting buying aggression near the low. When price returns to that area later, it reacts to the upside. These are the 2 main ways of observing support and resistance levels with the footprint, but in my point of view, the best value we can get from the footprint is using it to confirm support and resistance levels we would normally find in a candlestick chart. This requires a contextual reading of the footprint chart in light of the support or resistance level in question. Before we observe examples of that, we need to be aware of 2 important aspects of the footprint: the price imbalance relationship and the price delta relationship. Price imbalance relationship is observing the position of the closing price of a candlestick in relation to the bid and ask imbalances that occur in the footprint. This is important to identify potential absorption or initiative of market players, which are important features of market reversals. Let's observe the absorption pattern. If you see price closing below an ask imbalance, the interpretation is that buyers are being absorbed by sellers. Since an ask imbalance generally means buying aggression, price action should confirm that by closing above it. When it doesn't, we can infer that sellers are absorbing the buyers. If you see price closing above a bid imbalance, the interpretation is that sellers are being absorbed by buyers. Since a bid imbalance generally means selling aggression, price action should confirm that by closing below it. When it doesn't, we can infer that buyers are absorbing the sellers. The absorption pattern is sometimes not enough to spot a reversal. We need to confirm it with the initiation pattern right after. The initiation pattern is nothing more than the agreement between imbalances in price. The buying initiation pattern occurs when we see price closing above imbalances in the ask. The interpretation is that the imbalances in the ask indeed represent buying aggression with directional intent. The selling initiation pattern occurs when we see price closing below imbalances in the bid. The interpretation is that the imbalances in the bid indeed represent selling aggression with directional intent. One possible way that prices will reverse is by the combination of absorption and initiation. For example, imagine that we observe price approaching a support line. As price moves toward the line, we see price closing below imbalances in the bid, which agrees with the idea of selling pressure. Once price hits the line, we see an absorption pattern, meaning price closing above bid imbalances. Right after that, the market switches to an initiation pattern. We see price closing above imbalances in the ask in a clear bullish candle. The same logic, of course, applies to a bearish reversal, like you can see here. The important point is that you can use this pattern to help in the confirmation of any type of support and resistance line. It can be standard support and resistance, channels, pitchforks, dynamic lines like moving averages and Bollinger Bands, Fibonacci levels, and so on. Another important information we can find in the footprint is the relationship between price and volume delta. Volume delta is nothing more than the difference between ask and bid volume. As we saw earlier, a bullish candle usually has positive delta, and a bearish candle usually has negative delta. Positive delta means more volume in the ask, which agrees with the idea of buying aggression. Negative delta means more volume in the bid, which agrees with the idea of selling aggression. However, bullish candles don't always have positive delta, and bearish candles don't always have negative delta. This is known as delta divergence. This is important because if all that happened in the ask was related to trading activity directed to adding buying pressure in the market, and all that happened in the bid was related to trading activity directed to adding selling pressure in the market, delta divergence would not exist, but it certainly does. Delta divergence is a sign of absorption, so it complements the patterns we saw earlier. When a bullish candle shows negative delta, it is a sign that buyers are being absorbed. When a bearish candle shows positive delta, it is a sign that sellers are being absorbed. For example, in this image you can see that the candle highlighted is bearish, and it has positive delta. That perfectly complements the fact that we see price close above imbalances in the ask column, which would be a sign of buying initiation. An added detail here is that these are stacked imbalances. Notice how price continues going up afterwards, confirming the notion that sellers got absorbed by more powerful buyers. The footprint shows the volume delta in each candle, but we can also observe it cumulatively over time in what's called cumulative volume delta, or CVD. The advantage here is spotting exhaustion and absorption signals. This works similarly to spotting divergence signals in oscillators, in the sense that we compare the evolution of price extremes with the corresponding extremes in the cumulative volume delta. Let's study the exhaustion and absorption patterns. If price is creating higher highs but the CVD is making lower highs, it means that buyers are losing steam, and price might reverse to the downside soon. That is the buying exhaustion. If price is making lower highs and the CVD is making higher highs, it means that buyers are trying to go up, but sellers are absorbing them. So this movement is not being represented in price action. This is also an indication that price will go down. This is the buying absorption pattern. If price is creating lower lows, but the CVD is making higher lows, it means that sellers are losing steam, and price might reverse to the upside soon. This is the selling exhaustion. If price is making higher lows and the CVD is making lower lows, it means that sellers are trying to go down, but buyers are absorbing them, so this movement is not being represented in price action. This is also an indication that price will go up. This is the selling absorption pattern. We can, of course, use the cumulative volume delta divergence patterns to contextualize what happens with price imbalance and price delta relationships in the footprint. Another important tool of order flow analysis is the volume profile. The volume profile is a variation of Steidlmayer's market profile. It simply displays the activity across different price levels over a series of candles, so it's a volume at price tool. Market profile is similar, but it shows the level of activity in each price level based on time instead of volume. Let's learn the main features of the volume profile, and then we'll learn how to use it for market analysis. The volume profile is a horizontal histogram that displays the level of activity in each price level based on volume. The footprint shows the volume action inside the candlestick, but the volume profile shows the volume action across a series of candlesticks. These two tools are actually very similar. Just like in the footprint, in the volume profile we have the value area, which represents 70% of the traded volume, in what's called the POC, or point of control, which is the price level with the largest volume or the peak of the histogram. Some traders choose to use a value area setting of 40% to get more precise readings, since the 70% can be too wide sometimes. In the volume profile, Areas of high volume show areas of price acceptance or balance, meaning areas where buyers and sellers relatively agreed about the fair value of the market. Recall that these areas can act as magnets for price. Areas of fair value are also areas of high liquidity. Areas of low volume in the profile show areas of price rejection or imbalance, meaning areas where buyers and sellers disagreed about fair value. Areas of imbalance shown by low volume in the profile have low liquidity. Recall that in areas of low liquidity, price action can travel greater distances with less market activity. Areas of low volume can repel price. All of this, of course, assumes that no new significant information has changed the perception of buyers and sellers. In summary, areas of fair value shown by higher volumes in the profile tend to attract price action. Areas of imbalance given by lower volumes in the profile tend to repel price action. This is very useful to judge the quality of support and resistance levels and the power of supply and demand zones in the chart. There are many details about the volume profile, but for the context of this course, this tool is very useful to identify previous areas of fair value where price might get attracted to in the future and reverse. For example, in this chart you can see that I plotted the volume profile in the upward price movement from A to B. The idea here is to understand where in this trend was the fair value area, which is highlighted by the space between blue lines. Price comes back to this fair value area later on and resumes direction to the upside. From this example, it's clear that the areas of fair value are relative to where we plot the profile. For example, if we change the profile to this upward price movement, the fair value area changes and we end up catching another demand zone. Price does react to this demand zone as well. In summary, different profiles will point to different fair value areas, so it's important to contextualize the volume profile with other tools in order to extract the greatest value from it. Let's look at some examples of how these different order flow techniques can work in combination. In this chart, we have the mini S&P 1-hour time frame. Observe that I have marked market extremes from 1 to 3. In this candlestick chart, we can see a small volume profile plotted on the downward movement from 1 to 2. The idea here is to detect the fair value area of that particular movement and its point of control, which is represented as the red line. The indicator at the bottom is the cumulative volume delta. In this example, between lows 2 and 3, we have a selling absorption example, meaning that the CVD is producing lower lows, showing an accumulation of negative delta. But at the same time, price action is not being able to go down. This means that sellers are being absorbed by buyers, which is of course a bullish signal. In this case, price is reaching the point of control as support in number 3, and that is happening in the context of a selling absorption in the cumulative volume delta indicator. This is a good moment to employ the footprint chart in order to understand what's happening with the candlesticks that are touching the point of control as support. That will give us further insight onto why price reacted so violently after the point of control. Here we have the footprint chart of those two candles. In the first candle, we have price closing below 2 stacked imbalances and one single imbalance in the bid, which is a sign of selling initiation. However, we do see price closing above an imbalance in the ask, which is a sign of buying initiation. The story here is that for the most part, this candle had a lot of selling power until it met the support outlined by the point of control we just talked about. After touching the line, we can indeed see buyers emerging at the bottom. Notice also that we do see a high volume node occur below the close of the candle. That means that the greatest point of battle between buyers and sellers happened there in the area where the buying initiation began to take place. With that said, price closed within the fair value area, which is an indication that buyers and sellers relatively agree about the fair value, at least in this candlestick in isolation. In terms of price delta relationship, we can see that there is no divergence. We have a clearly bearish candle with a negative delta. A positive delta in this scenario would have been a stronger piece of evidence to the upside. In the next candle, we see a strong bullish move. The first thing that draws attention here is the absence of imbalances in the bid, and price closing above multiple imbalances in the ask, suggesting a strong buying initiation. Other than that, we see price closing above the high volume node and the whole fair value area, indicating that now there is an imbalance. Buyers and sellers are not agreeing about the fair value like in the previous candlestick. Delta is positive, confirming everything we just saw. The story given by the footprint can be summarized as follows. Price encountered a support while it was going down with violence, and a small degree of buying initiation began to take place. In the next candle, we see very strong buyers initiating a movement with very clear signs. That scenario ended up in a very large bullish move afterwards. Let's also now forget about the origin of the support line given by the point of control of the volume profile, and the fact that all of this was happening within a selling absorption in the cumulative volume delta indicator. Let's now look at what happened in the same time, but now in the E-mini Dow Jones futures. Recall that the S&P and the Dow Jones are highly correlated, so it's not uncommon for relatively the same opportunities to emerge in different ways in these markets. In this chart, you can see that I plotted an Andrews pitchfork in market extremes 1, 2, and 3. The pitchfork then gives us a projection about the end of 4 at the median line. Order flow analysis would enter the scene here to aid in the confirmation of the median line as a support level. So let's observe the footprint of the candles that interacted with the median line in this case. In the first candle, we have ambiguous readings in relation to imbalances in the bid and ask columns. We have price closing above and below both imbalances in the bid and ask. Let's contextualize that with other elements of the footprint. In this candle, it's pretty clear that most of the volume happened in the lower shadow, judging by the darker colors in there. Two important details here are that price seems to be moving away from the fair value area. Notice how it closes almost at the value area high. That gives the impression that buyers and sellers started to disagree about the fair value here. The second detail is that we have delta divergence, meaning that we have a bearish candle with positive delta, and that is a sign of selling absorption. This is confirmed in a way by price closing above the stacked bid imbalance at the very bottom of the candle. In the next candle, this notion is confirmed. The ambiguity in the imbalances disappears. We have price closing above a series of imbalances in the ask and one imbalance in the bid. We also have price closing above the fair value area, and notice also how the fair value in this candle is higher than the fair value area from the previous candle. Delta divergence also disappears, and we now have a delta that agrees with buyers. When you combine all these elements in a context, we can see price turning at the median line of the pitchfork, and the result is already obvious, a massive upward movement just like we saw in the S&P. As you can see in these examples, order flow analysis gives a more granular view of what's happening between buyers and sellers. It's almost like putting candlesticks on an X-ray machine. Some people claim you should stop using candlesticks and focus on the footprint instead. That's misleading. Recall that candlesticks are the best representation of price. The footprint is about volume activity. Price and volume are the two types of information generated by the market. But price is at the top of the hierarchy. Volume only helps contextualize what happens. The greatest power comes when we combine these tools, not when we choose one over the other. We can go a lot deeper into order flow analysis, but this serves as an introduction. Let's now move on to the advantages and disadvantages of using order flow, starting with the advantages. Number 1. Order flow is an effective way of analyzing volume action, which in combination with price action forms a reliable framework of analysis. 2. It provides multiple ways of seeing market information in ways that might not be obvious by looking at price action in isolation. 3. It allows traders to put an X-ray on price reversals. 4. It provides granular market insight while analyzing the real-time reliability of support and resistance levels, which is fundamental in any serious trading strategy. 5. It can also provide new ways of seeing support and resistance levels that might not be obvious just by looking at price action. There are, of course, a few disadvantages too. Number 1. Order flow analysis can be overwhelming to learn in the beginning due to the way the tools work and the intricate nature of market microstructure. 2. Like we saw, order flow analysis is not devoid of problems. There is the problem of ambiguity, the problem of manipulation, and the problem of lack of transparency. Even though there are ways of dealing with these issues, they cannot be completely eliminated. 3. Order flow tools can generate confusion if the trader lacks the ability to put these tools under the appropriate perspective. 4. The real-time analysis of order flow tools to validate support and resistance levels requires great familiarity with the contextual analysis of footprint elements, which can be a challenge, especially in lower time frames, since market analysis requires greater speed. This is it for this course. I hope you have found value in it. If you wish to go deeper into price action reading, please check out my course called Fractal Trading, Mastering Price Action and Beyond in the video description. For more information, visit my website fractalflowpro.com or send me an email at support@fractalflowpro.com. If you enjoyed the video, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications, leaving your feedback below in the comment section, and sharing this video with your trading community. Thank you very much for watching, and I hope to see you in the next videos. Take care.